Um, okay, recording's in progress. Great. Thank you. I thought, insurance is such an exciting topic, and I'm sure no one will doze off or fall asleep right after dinner, full of carbs. So we're going to try to keep it interesting as we can, engage you as much as you'd like to be engaged. If you're familiar with how the Zoom platform works, there is a option to input information into a chat field. It's at the bottom of your screen. It's, I think, the third or so icon over in the middle. It's labeled chat, and you can put any questions you have there. Lizzie's going to kind of monitor that for us, and I'll kind of pause along the way, and then we'll kind of look at some of those questions you might have. You can just put them into the general chat that everyone can see. So when you go to do that, I think that's what it defaults when it comes up. It just says meeting group chat, and you can just enter it there. Everyone will see the question, but that'll be the easiest way for us to try to answer those along the way. If you ultimately end up having a question after we're all said and done, again, you can certainly email Greenacre, and they'll get me those questions. We'll try to get them answered the best we can. Before we get started, let's see if anybody wants to use that chat feature, and we'll do a little bit of maybe an icebreaker, ask you a question. So, if you could have any superpower, like that the superheroes have, you could fly or you could have unlimited strength or whatever, what would it be? If you're in a position where you can type that in the chat, let's see, you don't have to respond if you don't want to. Maybe you already have a superpower and you just don't want to share it. It's okay. But if you don't have one, oh, time travel. I like that. Thanks, Joshua. Share some of those in the chat with us, and that'll be a fun way to just kind of make sure everyone's paying attention and along with us. Oh, super memory. I think the older we get, the more we wish we had just our regular memory. So, that's awesome. Well, feel free to keep entering those into the chat field. We're going to get started. I'm going to share my screen off and on a little bit with some of the notes, just so you can see some of this information. Very basic, but again, you'll be getting this recording if you want later as well. So what we're going to talk about tonight is insurance for community associations. Now, I'm going to make an assumption, and maybe, Lizzie and Janet, you can kind of give me a head nod if this is true. I would say a vast majority of who's on the call is going to be from an HOA versus a condo or a townhome. Is that probably right? Or do you think we have a lot of condo, townhome, maybe a little bit of everybody? Mixture, maybe?
We probably have a mix, yeah.
Okay. I know that you guys tend to manage more HOAs than anything else, so that was kind of my assumption there. But the things we're going to talk about are going to apply across the board for the most part. If there's something that doesn't quite apply, I'll try to differentiate that as well and kind of mention it. And then if you end up having some additional questions along the way on a specific topic, feel free to throw that in the chat as well. A couple other things real quick that were mentioned as far as superpowers. Someone would be able to start and stop time and then become invisible. I was going to ask, if you had the power of invisibility, what's the first thing you would do? But I thought we might get ourselves in trouble with that one. So I left that off the table. But Terry, if you become invisible, let us know where you want to go, what you're going to do. So let's take a gander here into community association insurance. What we're going to do is we're going to kind of look at all the different lines of coverage that most associations are going to be purchasing. And if there's anything required by statute, I'll do my best to mention that. We're probably covering several different governing statutes here on the call tonight. 718 for condos, 720 HOA. We got probably some townhomes, some co-ops. So not all those statutes are the same, of course, and not all of them have the same requirements, but I'll throw some stuff out there if I know for sure it's a statute requirement. So let me go ahead and share my screen real quick, and let's make sure I pick the right one. All right, I think this is it. Okay, so can you guys see that screen? Maybe Lizzie, give me a thumbs up if you guys can see what I'm sharing. Great. All right, so let's talk first about, and I'll kind of zoom in and out of this a little bit, but let's talk first about property insurance. Now, if you're in a condo, this is the biggest part of your bill, right? Of your expense of all your insurance is probably your biggest expense if you're in a condo, and if you are in a condo, the property insurance is the biggest part of the insurance expense. If you're in an HOA or some other type of association, maybe you don't have any physical property. Maybe you only have like a mail kiosk or possibly a clubhouse, a pool. Maybe it's nothing at all. You may not have anything at all. You may not have a gate, a fence, nothing. You may have no property. So property insurance may not apply to every community association. But whether you're a condo insuring a multi-million-dollar building on the beach, or whether you're an HOA with just a mailbox kiosk and maybe some small ancillary property, property coverage is important. And there's some bits and pieces that I want to kind of talk to you about. The first thing I want to mention that's not on the screen, and that is the fact that we highly recommend that you get an insurance cost replacement appraisal every 3 years. Now, condo 718 condo statute says you have to get it every 3 years for your condo. But if you're in an HOA and you've got maybe a clubhouse and you've got a pool and some fencing and a security gate and maybe some gazebos or whatever it might be around the community, we are going to highly recommend, although not required by statute, we're going to recommend that you get an insurance replacement cost appraisal. And that appraisal, and get that done every 3 years, because that's going to basically make sure that you're insuring those items to value. Because I can't tell you how many times I talk to a board or a manager and I say, okay, you've got the clubhouse insured for $450,000. How'd you come up with that number? And they say, I have no idea. That's just what it was before I got on the board. Okay, well, maybe we should figure out a good replacement cost so that we're insuring that physical item to its proper replacement value. And whenever you're talking about the insurance replacement value of an item, remember that it's not about the market value, it's about the replacement cost. So I typically say bricks and sticks and labor, right? What's the material and what's the labor to rebuild that structure in today's dollars? Even if it's a building from 1970, what's it going to cost to rebuild it today? That's what that appraisal will show you. So when you are getting an appraisal, make sure you're getting an insurance replacement cost appraisal, not a market value appraisal. And not all appraisal companies do those. So make sure you're finding that out. Again, you could always ask your manager at Green Acre, reach out to us. We could help guide you to a vendor that could help supply that to you. So let's look at my screen here and a couple of the things to know about property insurance. First off, property insurance is insured on some different types of forms. Now, because our entire topic tonight is about insurance, I'm going to go into the weeds a little bit for you. And so some of this may not be something you need to remember on a regular basis, but when you do look into your policies, I kind of want to let you know what you're looking at. So property insurance is typically written on 3 different types of forms, either basic form, like letter A, broad form, letter B, or special form, letter C. I would say a vast majority of the property insurance you're going to run across is going to be on special form. Special form is it's a very broad form of coverage. You really won't see broad form much anymore. You will see basic form from Citizens, and we'll talk about Citizens a little bit later. You may be aware that Citizens is the last insurance carrier, last resort. It's a paragovernmental organization, and the forms that they write on what's called basic form. And so you need to know that if you have a Citizens policy. But if you're not with Citizens, chances are you have special form, which special form gives you coverage typically for water damage. If it's a hurricane policy, if it's a fire policy, all the different types of policies that are out there. But the special form means it's very broad and that it's going to cover things like water loss from a leaky pipe, things like that. If you do have basic form, you'll see letter D there on the screen. You need to have a DIC, which stands for difference in condition. So if you have a Citizens policy and it's a multi-peril Citizens policy, you should also have paired with it a DIC, a difference in condition. So if you don't have a difference in condition, you need to talk to your insurance agent about that. Again, this is just property coverage. All we're talking about right now is property. One of the major forms built onto property is also called building ordinance and law. So ordinance and law is a type of coverage that provides for code enforcement issues and has some coverage for debris removal. And if you did have a building that was forced to be torn down by maybe the governing municipality, the city, the county, if it was forced to be torn down, you might have enough coverage to rebuild the whole building, even if the whole building wasn't damaged. The older your buildings are, if we're insuring buildings, the more important ordinance and law is, but also the harder it is to get because the chances of your buildings being out of current code are very high. So carriers don't want to sell you that coverage because let's be honest, right? I mean, insurance, we all probably have a love-hate relationship with it, probably more hate than love. And unless you filed a claim and it paid out and it made you happy, but you feel like you're paying the premiums month after month, year after year, you never file a claim and the prices just keep going up through the roof and you get frustrated with it. And I understand. I might sell insurance, but I also buy insurance, right? I work from home. I'm living in my home. I have to buy insurance on my car. So I understand to some degree what you're going through as well. But knowing that ordinance and law specifically is a coverage, the older your buildings get, the more important it is to try to have that coverage. And then the last piece listed there is agreed amount. And what that means is everyone agrees, the insurance carrier and you both agree that the amount listed on the policy is the amount that the building is insured for. Again, whether it's a residential building or it's a pool house, if you have this special, not special, but if you have this endorsement called agreed amount or agreed value, then no one's going to argue over the value of the property. They agree, you agree, but you're not going to get any more money if it's blown away, but you're not going to get less necessarily except for the deductible, as long as it's written on basic form and written with replacement cost. If you don't have agreed amount, then you'll see there, big letter B says co-insurance. If you don't have agreed amount, you're going to have a co-insurance. And that math formula across the middle there is how this is calculated, or how co-insurance is calculated. And co-insurance, by the way, is a penalty. So I've opened up a calculator and I'm going to pull it over here to the screen so you can see it. And we're going to do a little bit of math. So if you have any math teachers on the call, you're probably super excited. And the rest of us are going to tolerate it for a minute. But the math formula that you use to figure out the penalty is did divided by should times loss minus deductible equals the amount. So what we're going to say for our example is that we insured the building for $100,000. But at the time of loss, the insurance company will do their own appraisal. And what if they determine that the building's replacement cost was actually $150,000? So we're going to divide that by 150. That's going to give us a factor. Now, let's say that of the $100,000 building, or in this case, the $150,000 building, there was $50,000 worth of damage. So now I'm going to multiply times $50,000, and that's going to give me $33,330. Instead of $50,000 in damage, you're only going to get $33,000, but you still have to subtract your deductible. So let's assume that your deductible is $10,000. So for a $50,000 loss, you're only going to get $23,333 because the building was underinsured. And if you had an appraisal, chances are the carrier would have given you agreed amount. But if you don't have an appraisal, they're not going to want to give you agreed amount. They're going to put a co-insurance penalty on there. So I'll kind of leave it at that, but just know that co-insurance can come back to bite you if the building is underinsured. Co-insurance is a penalty. When you think co-insurance, you probably think health insurance, and you think, oh, a co-insurance is like a copay or something like that. It couldn't be more different when it comes to property insurance. So the lesson or the takeaway is this: if you have an appraisal, you should be able to get agreed value. If you don't and you have co-insurance, make sure that building is insured to value. Otherwise, you could receive a penalty come day of the claim. All right. Replacement cost versus actual cash value. We're still talking about property coverage here for a few more minutes. Replacement cost means that if it's a $100,000 building, it's insured to the proper value. It's completely destroyed. you're going to get $100,000 minus your deductible. But if it's insured at actual cash value, that's going to be a depreciated value. So every single one of us that own a car and insure it, it's insured at actual cash value. They don't insure cars at replacement cost. If you got a 10-year-old car, you're going to get the value of a 10-year-old car if it's totaled. You're not going to get the value of a brand new car. But your building, on the other hand, if your 50-year-old building is insured at replacement cost, you're going to get no depreciation. You're going to get the full amount of the building minus deductible on your claim. But if that building is insured at actual cash value, there will be a depreciation factor. And the older the buildings get, the older your roofs are, the more carriers want to put actual cash value on it. So make sure when you're looking at your policy, you make sure it's replacement cost versus actual cash value. Now let's talk for a minute about the different types of deductibles. On a property policy, you're going to see these type of deductibles most of the time. You might see a wind hail deductible. You might see a named storm. You might see hurricane, or CYHD stands for calendar year hurricane deductible. You might see all other wind, and then the last one is all other perils. So let me talk briefly about A through D. Those are all wind related in some nature. If you had wind hail as your wind deductible, no matter what type of wind it was, you would be charged your wind deductible. And typically wind deductibles are a percentage of the building's value. But if you had named storm, you would only get charged your wind deductible if the wind that hit your building was actually a named storm by the Weather Center, National Weather Center. And additionally, if you had a hurricane policy coverage, then only hurricane wind, 74 mile an hour or greater wind, would be the hurricane deductible or the wind deductible. The reason why that's important is because letter E, your all other perils deductible, typically your all other perils deductible, which is designed for fire and water loss, it's typically a dollar amount, $5,000, $10,000, $25,000, and it's typically much smaller than your wind deductible. So for example, if a hurricane hit your building and you had a hurricane deductible, you would be charged the hurricane deductible. If a tropical storm hit your building and you had a hurricane deductible, you would only be charged your all other perils deductible. Same thing would be true if a named storm hit your building and you had a hurricane deductible, you'd still only be charged your all other perils deductible. Now, I know it may sound like I'm talking in circles here a little bit and it might get confusing, but when you look at your policy for property, if you see, oh, it's a hurricane deductible, or you saw, hey, it's a wind deductible, a wind hail, those are not the same things. In your mind, you might think, oh, that's a wind deductible, it's a hurricane deductible. But for insurance languages, those are very different deductibles, and they only apply during certain scenarios. So make sure you talk to your agent about what type of wind deductible you actually have. Is it a hurricane deductible, named storm, wind hail? What kind of hurricane deductible or wind deductible do you have? And there's a big difference. And the last thing I'll say on that is, by the way, the hurricane deductible is going to be more expensive than the named storm or the wind hail because it only applies in certain scenarios, and your all other peril deductible applies the rest of the time. So it's going to cost you more to buy a hurricane deductible versus a wind hail deductible. Now, there are different types.
Doug, I'm sorry to interrupt you. We have a question in the chat just before you move on, because it kind of goes into item C. Thank you so much.
Yeah, let's take a look. So, okay, so is that from Carmen, the question, what is the difference between the insurance replacement cost appraisal and the reserve study, since the reserve study also addresses replacement cost? Great question, Carmen. There is typically a big difference. Now, you might hire the same company. They might do the insurance replacement cost appraisal, and they may also do the reserve study, and they may put that information all within the same document. But the reserve study is looking at what it's going to cost to rebuild that item when it runs out of its life. So it's going to say, okay, in 20 years it's going to last, and in 20 years it's going to cost so much to replace it. So you need to save X amount of dollars every year for the next 20 years to have enough money to replace it. The insurance replacement cost appraisal says, what will it cost today? And that's why the condo statute requires you to get that replacement cost appraisal every 3 years. Because 3 years from now, it's going to cost a little more to rebuild that building, and 3 more years is going to cost a little bit more. So if you're in a condo, you have to have the insurance replacement cost appraisal. And then you probably also required now to have the reserve study. If you're 3 stories or more, you've got to have all kinds of other reserve studies done. It's a whole nother conversation if you're in a condo that's 3 stories or more. But hopefully, to simply answer your question, Carmen, the reserve study is looking at the replacement cost down the road, and it's backing into that and telling you how much money to save for that. The replacement cost appraisal is saying, what's it going to cost to rebuild that building today? And then that's the amount you're insuring it for today. So hopefully that answers that question. So back to the notes. I have under letter E, wind only or excludes wind. Please know that there are different types of property policies. There are wind only policies. There are what we call excludes wind or X-wind policies. You might have what's called a multi-peril policy. So your policy for property covers wind and it covers fire and all other non-wind related losses. But especially if you're on the ocean or in an older building really close to the water, you might have a wind only policy, and then you might have an other than wind policy or an excludes wind policy. So you might have 2 property policies that you pair together. Citizens, I won't spend a lot of time on Citizens, but again, know that Citizens is the insurer of last resort. It's technically not a government organization. It's a paragovernmental organization. They are subject to things like the Sunshine Law, where they have to disclose documents. All of their rates and filings are public record. You can only go to Citizens in certain scenarios. Your next best option has to be 20% more than Citizens, or you can't even buy a Citizens policy. Some people have strong opinions about Citizens because it is run by the government, but it's there if you need it. And if you are in a condo, your insurance agent probably should be giving you a Citizens option as well, if it's available to you, at least to compare it to the other pricing. Last thing I'll mention here on property is sinkhole versus catastrophic ground cover collapse. If you're in, north of Tampa, getting up into Pinellas, Pasco, where sinkholes are more common, this coverage can be harder and harder to get on property. Sinkhole versus catastrophic ground collapse. The difference is when we all see a helicopter on the news fly over what we would call a sinkhole, we'd all call that just a sinkhole. But for insurance purposes, there's a difference. If there's a slow settling of the ground that maybe creates a crack or creates issues with the building, that's going to be considered a sinkhole. If the ground just opens up and swallows something in a matter of minutes, that's going to be considered catastrophic ground cover collapse. And so most property policies in Florida have cat ground cover collapse. You may or may not be able to get sinkhole coverage. So if you're in an area that's prone to that, you might want to talk to your agent about the difference between those and which ones you can even purchase. So sinkhole or catastrophic ground cover collapse. All right, so I'm going to pause for a second before we go on to general liability and ask and see if there are any questions. I'll stop sharing my screen for just a second so you can see my lovely face, and I can tell that some of you are super engaged and excited. This is such an exciting topic. Sorry, I hope I'm not putting you to sleep too bad. Any questions in the chat you want to put in on property insurance? If you're in an HOA, you're probably like, whoo, I'm glad we're done talking about that because we don't have hardly any property. So, all right. What would apply to a golf course, Clarence? So it depends upon, are you insuring the entire golf course? Are you insuring the just structures? Is the golf course a part of the actual HOA? There could be a lot going into a golf course. Most of the time in Florida, you see the golf course as a complete separate legal entity from the HOA, but that's not always the case, especially for some reason in Naples. And maybe it's just because they've had communities with golf courses for so long. I've seen several that the HOA actually owns the golf course and everything. If that's the case, that's a real deep dive discussion on everything from the employees to the pro shop to everything going on there. but you know, you have, let's see, what's the roof life? Okay, another question we'll answer in a second. So for the golf course question though, you know, that's a real deep dive. You know, is it property coverage? What all is going on with the golf course? I would say talk to your agent about that. I'm happy to engage in a conversation about that as well. What is roof life for most condo association property insurance? Great question, Wayne. Roof life, age of roof is like a huge topic right now. There are some insurance companies that will not write a roof over 13 years old. There are some that at 15 years of age, they're going to start putting actual cash value. We talked about that earlier, right? About the depreciated value. Some insurance companies, if the roof is over 15 years old, they're going to depreciate the value of the roof. I'll also tell you that Citizens, if the roof is 15 years old or older, they're probably going to require to get a roof condition inspection. If it's 20 years older, they absolutely will. That inspection has to include pictures. They have their own proprietary form that the roofer has to fill it out on. And by the way, it has to be a licensed roofer or a licensed general contractor. It can't just be an inspector. It has to have pictures that goes along with it. And it has to show at least 2 years of life left or they won't write it for Citizens. Most companies are going that way. And when we talk about roof, and this would be true even in an HOA if it was maybe for a clubhouse or something. If you are considering replacing your roof, please, please, please talk to your insurance agent first, because a lot of people think, especially in a flat roof, oh, well, the roofing company came out, they gave us a quote just to put a new covering over it or a membrane or a coating, and it's going to be way cheaper. And they said we get a lifetime warranty on it. I can tell you the insurance company doesn't care. If you've not taken off the roof and seen what's underneath the roof covering, the substrate, they don't consider it a new roof. So you can't roof over, shingle over, do anything over top of an existing roof. They will not consider it a new roof, and you're going to spend a lot of money. You're going to think you did the right thing. And at least from an insurance perspective, you're going to be out a lot of money because they're still going to come back and say, sorry, if you didn't peel the old roof off, it doesn't matter. Some people say, well, we did core drillings around the roof. Well, that's great. And in those core drilling areas, maybe everything looked fine. But what about the other 99% of the roof that you didn't drill? Those areas could be damaged. So insurance companies are getting stricter and stricter in this hard market about roof age and also about what it means to replace a roof. So keep those things in mind. Another question, why is property insurance higher with a new roof, recently replaced roof, and I have new wind mitigation, the rate increased? I can tell you, Dennis, that the rate didn't increase because of the new roof. It may have increased simultaneously with you getting a new roof, but there could be one exception to that, and that would be is if your old policy had actual cash value on the roof. If it had a replacement cost value on the roof, they were already planning to replace the roof with a new roof regardless of the age of the roof. So it should not have impacted the price. If you got a renewal, the price went up because the price went up, not because you got a new roof. Because again, if it was a replacement cost appraisal, they don't care how old the roof is, or not an appraisal. If the policy was written at replacement cost, they're going to give you a new roof anyway. So they're pricing it the same way regardless of the age of your roof. Maybe your old roof, you're getting some roofing credits or something you're not getting now, but I have a feeling that the price just went up. It didn't go up because you got a new roof. That would be my assumption, and you might be able to prove me wrong, but after doing this for 15 plus years, getting a new roof it's not like a car. Oh, I get a newer car, so therefore my insurance goes up. Well, yeah, that does, because remember, that's an actual cash value depreciated policy. The newer car is more expensive than the older car. So in that scenario, it makes sense that the rate went up. But for a roof on a building that has replacement cost valuation, it shouldn't go up simply because you got a new roof. If you change the roofing material, maybe, but chances are that's not the reason. We've seen increase in insurance, obviously, drastically over the last several years. It's starting to slow a little bit, but I have a good feeling your rate went up just because it went up. All right, so let's move on. If there are other questions about property, that's fine. We can always take those in the chat. I'm going to go ahead and share my screen again, and we'll talk about general liability. All right, so general liability. I'll just zoom in on that section a little bit. You can kind of ignore the directors and officers section.
We don't see your screen, Doug. I'm sorry to interrupt you
Oh,
again.
thank you very much. I didn't finish clicking share, so thank you.
I've done that before, no worries.
Yeah, I'm sharing now. We can see it, right?
Yep, you're all good. Thank you.
Awesome. Thank you so much. So, general liability. This is going to be a policy that every association should have. I will tell you that not every association does. One of the good things, and Green Acre didn't pay me to say what I'm getting ready to say. They can if they'd like, but they didn't. And that is they do a really good job of helping their associations make sure they carry the proper coverages in cooperation with the insurance agent, of course. But I can't tell you how many associations I run across that don't have a general liability policy. They think they don't need it. They're not required by statute to have it. So they decide, no, let's just save the money. And what's funny to me is the associations that seem to do sometimes the frugal thing on insurance, they're an HOA with like 2,000 homes. And even if the insurance cost them another $1,000, you start dividing that by how many homeowners there are, and you couldn't even buy a cup of coffee per year for what the insurance cost is. But sometimes large associations, HOAs in specific, tend to not want to carry general liability. So let me make it clear, you should carry general liability. You're not required by statute, but you certainly should. I like to call a general liability policy a slip and fall policy. Basically, it covers a couple things. We're going to talk about it here on some of these bullet points. But basically, general liability, I call it again a slip and fall policy. It covers two things. It covers bodily injury and property damage. And I'll give you two very simple scenarios. So let's say I come into your community, I slip and fall, or I trip over a raised sidewalk. I get injured. I hire Morgan & Morgan. I give them a bunch of free advertising, by the way, because I always say Morgan & Morgan. But I hire Morgan & Morgan. We're going to sue your association because you should have ground down that raised sidewalk. I tripped. I hurt myself. It's my bodily injury caused by your association. And in that scenario, you would file a claim against your general liability policy. Now, let's say on that same trip, as I'm getting ready to leave your community, a tree falls on my car. Now, it's been a really bad day for me. I tripped and fell, and a tree crushed my car. But now Morgan & Morgan is going to say, look, we can prove that you were negligent. You didn't maintain your trees. That tree fell on our client's car. So you need to cover the cost of their car as well. Now, that's property damage of others. So you've got bodily injury of others and property damage of others. Those are the two main things that general liability is designed to cover against. I'm going to say a couple broad statements that you might disagree with. And as my father-in-law used to always say, he was a pastor, he would always say, you can disagree with me and it's okay, you can be wrong. But you can disagree with me on this if you want. And that is that it's always boggles my mind when members inside the association decide to file a lawsuit against their own association for something like a trip and fall. They're walking on the sidewalk. They walk their dog every day. Yes, there might be a little raised sidewalk or something or whatever, but they trip and fall and then they decide to sue their own association. So what ultimately ends up happening is if the association's insurance does ultimately pay on that claim, and if you have several of those claims, next thing you know, the insurance is going to go up, everyone's dues are going to go up, and it's going to impact the whole community negatively. Now, I'm not saying that you shouldn't file a claim when there should be one. And if your association was truly negligent, then maybe you do need to file a claim or get an attorney involved. But a lot of times we see kind of frivolous lawsuits going back against the association. And it's really just you're hurting yourself, and maybe someone's opinion is, well, that's okay. I got my big payout. And if my monthly dues go up a little bit, that's okay. I'm okay with that. The other thing that the board members find themselves in a conundrum in is no one wants to pay higher dues. So that same person that tripped and fell over the sidewalk probably voted against paying to grind down the sidewalks because they didn't want their dues to go up. So I know I'm being a little pessimistic here and kind of sarcastic, but filing claims against your own association for some simple things like trip and fall, it really can hurt everybody in the long run. It's really designed for when a guest comes into the community, if they hurt themselves and it's a legitimate claim, that's really what it's there for, to protect the association. So let me get back to my notes and off of my soapbox. So general liability limits, typically it's 1 million per occurrence, 2 million aggregate. Aggregate meaning the policy period. So that's very common. 1 million per occurrence, meaning each event that you had litigation, 2 million total per year. That's how much protection the association would have. General liability policies can also have hired and non-owned auto. I highly, highly recommend you talk to your agent. Make sure that your liability policy has hired and non-owned auto as an endorsement on the policy. What this does is if you as a board member go out to the store to buy some Post-it notes for the next board meeting, and in the process get in an accident, your auto insurance would be primary. But if it was ever discovered that you were on the board, which by the way, that's obviously public knowledge, we all know that on Sunbiz, and it was also discovered that you were going to get supplies for the association, the attorney could now name the association in that lawsuit. And if you don't have hired and non-owned auto, because it took place off premises, the general liability will provide no coverage. So the hired and non-owned auto extends to when someone uses when a board member or someone on a committee uses their personal vehicle, goes to run an errand, an accident happens. If the association gets named in litigation, they could receive protection. All right, deductible. General liability policies typically have no deductible unless you've had a lot of claims. And if you've had a lot of claims, then they might apply a deductible, $10,000, something like that. But most of the time, general liabilities have no deductible. General liability, defense cost outside the limit of liability. That's typically not an issue with general liability. I mention it, but the question is do the attorney fees eat up the limit, the $1 million limit, or are the attorney fees outside of the limit? That's something you can talk to your agent about and just understand the difference. And then a lot of times they want to know, is the property management company included as an additional insured? Yes, that can be the case. They can be added to that policy as well as a few other policies. And I know Green Acre is really good about making sure that they are added to those policies. We try to make sure we remember, but they are good at reminding us if we forget as well. Because again, they do a good job of reviewing the policies their associations have. All right, I'm going to pause for a minute. I see we've had some questions come in. So comment might have been about sidewalks belonging to the county or the city, not the HOA. Yeah, so I mean, you might have private or public streets, public sidewalks. That could be the case, even in a gated or in a non-gated community. The thing is, you're going to want to carry liability also because if I trip and fall, we're going to be naming the association in the lawsuit. Now, maybe ultimately you're not found responsible, but you're going to be named. And if in Florida, if you're named in a lawsuit, now again, I'm not an attorney and I'm not giving legal advice, but my understanding of the law in Florida is that if you're given a demand packet, you only have 20 days to respond. And if you don't respond to that, you're kind of admitting guilt. So you want your association to be able to at least respond. And in a case like where the sidewalks are owned by the city, but you're named in the lawsuit, you want to have the ability to file a claim and let that respond on your behalf. Craig also mentioned more of a comment than a question, and I don't believe you're necessarily wrong there. It just happens, right? I mean, I get it. People within the communities are going to sometimes just bring litigation because they don't care. People are going to do what they want to do. Let's see, Janet, our HOA covenants require residents to provide proof of property insurance. We don't follow up to collect this information if not given, and usually it is not provided by the residents. If there is a major loss to an uninsured townhome or single family residence, what are our potential risks by not following up on getting property insurance documentation? Great. Good comment, Dan. Better call Saul. Love it. Sorry, back to the last comment. Janet, your governing documents, if they haven't, again, this is something you can talk to your attorney or your manager about, but if your governing documents have no teeth in them to say, okay, you have to provide insurance, but if you don't, what's the penalty? If there's no teeth, so to speak, in the document, there's not much you can do anyway, right? You can ask for it. If they don't give it, what are you going to do about it? Unless your documents have provisions that say, if not provided, then we can do this, then if not, then I'm not quite sure you can do really anything about it. As far as what risk you're at, here's the biggest risk. And again, townhomes are at the greatest risk for this because you have communal living, so to speak, right? A lot of times you have a shared roof line over multiple units, but yet you're not responsible as the association for insuring those buildings. Now, let me caveat to say some townhomes are, right? Some townhomes do insure the buildings like they're condos. And in that case, it's a different scenario. But if you're not insuring the structures, if something bad happens, they don't have coverage, they go bankrupt. I've personally seen neighbors be forced to move out under the shared roof line because the building was considered unsafe. And it took years to repair the building because it was in foreclosure. The bank didn't repair it, all kinds of terrible things. So there could be some really bad outcomes if it's not insured properly. Those are kind of one-off scenarios, but something to look into, maybe talking to the attorney. Is there a way to put a provision where you could get some teeth in the documents if they don't provide it or they don't have it? What can you do about it? All right, let's try to fly through this. I know we have just an hour on this call, and so we're 41 minutes in. I want to keep moving and get through this because this is a really important part, the directors and officers policy. I'm not going to read all of this on the screen. And a matter of fact, to keep you from reading it and not listening to me, I'm going to leave it up there. That'll be on the recording for a second. Then you can always go back and look at it. And I'm happy to share this document with Lizzie. They can always make it available as well. But I'm going to stop sharing my screen so we kind of engage a little bit more than looking at the screen. So directors and officers, obviously, board members. I mean, this is crucial to you. And Lizzie, I guess I should have asked this. I know this is the folks on the call, are they all board members, some board members, things like that?
Yep, they're all board members.
Oh, all right. So we are preaching to the choir right now. That's exactly right. So this policy is for you, right? This is not the most important, but this is really important. And if your association doesn't have one or doesn't have a good one, I wouldn't serve on the board. And I wouldn't serve on the board of the Boys and Girls Club or your local church or anything unless this policy is in place. Directors and officers policies, let me say this, they're not all the same. Not all D&O policies are created equal. If everyone on this call has a car and we all say, well, we have a car, we could have a wide variety. I mean, I don't know, Dan Hicks, he might have a Ferrari. I don't know, he doesn't, but he might, right? I mean, and I might have a Yugo if it's still running from back in the day. Lizzie's kind of young, she might even know what a Yugo is, but at any rate, nope, see, she don't even know. But a car is not a car, right? I mean, they're very different. A D&O policy is not just a D&O policy. They're very different. You need to know there are a lot of differences on these policies. There are things like breach of contract, insured versus insured, soft hammer clause, all kinds of stuff. We could spend an hour just talking about the D&O policy and how many intricacies there are to it. You want to make sure that this policy is written by a carrier that writes for community associations. And as we mentioned about the general liability policy, you want to absolutely make sure that your D&O policy has either defense cost outside the limit or at least has additional defense cost. Because what you don't want to happen is that the $1 million limit, which is very typical, you don't want that $1 million limit to be gobbled up by attorney fees. And then there be a payment to be made, and there's only $200,000 left of the $1 million to pay because it all got gobbled up by attorney's fees. That'd be the worst case scenario. You want to make sure that the defense cost is either outside the limit or that there's at least what they call additional defense cost. Companies like Travelers, they don't have defense cost outside the limit, but you can buy additional defense cost. You can buy another $1 million of just defense cost. I absolutely recommend it. Or you move to a company who has defense cost outside the limit, meaning that there's unlimited defense cost and it doesn't eat into your $1 million limit. So those are a couple of things to make sure. Also, you want to make sure directors and officers policies have what they call post or predates or retro dates. And what that basically means is that as long as they can prove that there was a directors and officers policy in force back so far, the policy will go back and cover a board member that was on the board back in the day if they get named in a lawsuit today. And normally a directors and officers policy, the claim has to happen during the same policy year for there to be coverage. But if you have it stated on the policy that, yes, there was coverage back 15 years ago, and then a board member gets named in a suit from 10 years ago, that board member can also receive coverage even if they're no longer on the board. So that's an important little caveat to talk to your agent about. Do we have a retro date? Do we have what they call a past or a prior date? And it should be right in the policy. It'll literally be printed, January 6th, 2007. That means it'll go back and cover a claim of something that happened all the way back to 2007. So that's a very, very important caveat. Make sure that, again, that the defense cost is outside the limit, or that, again, you at least have additional defense costs. There are a lot of other little caveats and coverages that I won't dig into, but just make sure you're talking to your agent about your D&O policy. Deductibles for a D&O policy, sometimes they're $0, sometimes they're $1,000. They vary, but it shouldn't be anything more than maybe $1,000, $2,500 maybe if you're in a really big community. But typically it's $1,000, something like that. And then also, this is one of the policies that the property management company can be added on to, is the directors and officers policy. They can receive protection under this, because when you hire Green Acre, they have you sign this indemnification clause. Probably most management companies do, and they're going to expect your D&O policy to cover if they get brought into a lawsuit based around something around your association. So directors and officers policy is really important to have, but not just having one, having the right one, and make sure your agent is up to speed on that. All right, let's talk next, and I'll share my screen again. This time I'll do it right, Lizzie. I will share. All right. So let's talk about the fidelity or crime bond. Commonly called a crime bond, sometimes called a fidelity bond. That's their interchangeable terms. This policy is required. I know for sure it's required by 718, and I know for sure it's required by 720. The other statutes, I don't know off the top of my head if it's required or not. But if it's required by some of those other statutes, it's probably a good idea that you have it as well, even if it's not required, because usually the reason why it's required was a pretty good reason for everybody. So what is a fidelity or a crime bond? Basically, it's a theft policy. If a board member or a property manager absconds with funds, this policy can have a claim filed against it, and then the owners can be reimbursed minus a deductible for what monies were stolen by a board member or a property manager. And while this might seem like an outlier scenario, we just saw about a year and a half ago, 2 years ago down in Miami, I think 4 or 5 board members are still in jail today. I think they're serving 10 years or something like that for stealing money. They stole a couple $1 million. It happens all the time. Management companies, no offense to Green Acre, but management companies have stolen money in the past, and they've been shut down and arrested and all kinds of stuff. So it does happen. Sometimes you might say, well, I thought that my management company had their own crime bond. They probably do. But the law requires you to have your own, not for them to have one, for you to have one. And you could fire your management company today, and you still need to have a crime bond. So this is an important policy that every association needs to have. It's there to cover in case someone steals the money. It's not stealing it from the bank. That's FDIC and all that. This is someone who's allowed to have access to the money, but then steals the money. Now let's talk about how much you should have. It's a pretty simple answer. Take a look at your financial statements over a 12-month period. What's the most amount of money at any one time that you have in all of your accounts combined? Operating, reserves. Maybe you have an investment at the bank. You've got a CD or something. What is the total, and what's the highest total over the 12-month period? And that's how much your crime bond needs to be for. And if you're going to do a special assessment and bring in a bunch of money, or if you have a claim scenario where you're going to get a big claims check payout, you probably need to increase the limit and then reduce it once you've paid out those monies to do the repairs or the project or whatever it might be. My team and I, not my entire company, but just my team here in Florida, we insure about 600 associations. And I will tell you that every time I look at a new association, if someone from Green Acre or some other management company sends me a client, says, hey, can you review their current coverage, make sure that it's in good shape? I would tell you that 9 out of 10 times easy, the crime bond is underinsured. They got $1 million in the bank and they've got a crime bond for $100,000. If you're a condo or an HOA, you're in violation of statute immediately. You want to get that fixed. How much money do you have? That's how much the crime bond is for, bottom line. I won't spend a lot of time on all these other A through I, but these are other ways that money can be stolen. And when you look at your crime bond, talk to your agent about all these different lines and make sure you have the right amount on each one of these different types of coverages. Deductibles, typically, depending, the higher the crime bond, the higher the deductible. If you have a $100,000 crime bond, you probably have a $1,000 deductible. If you got $1 million crime bond, you might have a $10,000 deductible. So it's just going to vary based upon how much coverage you have. And I won't go into discovery form versus loss sustained, but that just has to do with when did you figure out, and you want to try to have discovery form. You want to have it when you discover the loss that there's coverage. If you have loss sustained form, you might have some issues with coverage depending on when you found out. 3 years later, you found out the money was stolen, you probably have no coverage. If you had discovery form and you found out 3 years later the money was stolen, you're probably going to have some coverage. All right. Well, there I listed again about the mandatory for HOA and condo for sure. Let's talk about umbrella. We only have about 8 minutes left, so I'm going to fly through these last policies. An umbrella policy is simply this. It's an augmentation of existing policies that you already have, and it's about liability policies. It's not about property. We're talking about general liability, directors and officers, and also work comp, which we haven't gotten to yet, but that's what an umbrella can do. It can sit on top of those other policies and it can increase their limit. You have a $1 million directors and officers policy. You've got a $10 million umbrella. If the directors and officers policy is exhausted, then the umbrella can kick in. So an umbrella is simply this. It's an increased limit that sits on top of other policies to make them bigger than they were originally. Flood insurance. We don't need to talk really much about this. If you're in a flood zone and you have property, talk to your agent about it. A lot of changes have taken place in the last couple of years with the FEMA, the National Flood Insurance Program. But if you have a condo, absolutely, and you're in a flood zone, talk about it. If you're not, you know, it's something you can carry, but flood is a discussion to have with your agent. Workers' compensation. This policy is highly, highly, highly recommended for all associations. It's only going to be $509 this year. Last year it was $565. The state of Florida sets the rate. People often say, well, you know what, Doug, we don't have direct employees. Why do we need workers' compensation? You need it for 2 reasons. One, it covers volunteers in case they get hurt. If your community has a lot of volunteer committees, someone gets hurt in their duty as a volunteer on that committee, they could file a claim for their injuries against this workers' comp to get their medical bills paid for. It's not about pain and suffering. It's just about covering the medical cost. And also, if an uninsured subcontractor does work and then sues the association because they get hurt, you could file a claim on this for their injuries. Now, we know that Greenacre probably vets all of your vendors, make sure they have insurance, but what if they cancel the policy and nobody knows? Things like that. So you want to have this workers' compensation. It's not required, but highly, highly recommended. Last one here, I believe, no, we have a couple other ones real quick. Equipment breakdown. If you're in a condo or a building that has an elevator, talk to your agent about equipment breakdown. It covers more than just elevators, but that's the scenario most of the time that you need it. So equipment breakdown, most important if you have an elevator, talk to your agent about it. If you don't, if you're not in a condo, it's probably not too relevant. Unless you have a multi-story big clubhouse or something, you might want equipment breakdown. Mold and sewer backup. This is a coverage that can be separate or added to property policy. It's designed for just what it sounds like. If there's mold or if water backs up through a sink or a toilet, normally that's not covered on a basic property policy. Mold and sewer backup can be added, or it can be a separate policy you can write. So again, if you have a condo, you might want to talk to your agent about sewer backup and mold coverage. Environmental impairment liability. If you have a hot tub, you better have one of these. Not to be completely gross, but there's a thing called Legionnaire's disease, and it's real. And I've seen claims filed because people have gotten it, and they typically get it in a hot tub. So if you have a hot tub or a spa at your community, you better have an environmental liability policy because no other policy will cover the claim. And if you have any kind of fuel storage, if you got gas to power a generator, you better have an environmental liability policy because if that fuel spills into the ground, the EPA will be all over you and it's going to cost a lot of money and you're going to wish you had this policy. So make sure you have an environmental policy if you have a hot tub or if you have any kind of fuel storage, something like that. Lender requirements. Again, I'm not a lender. I hate to dig into this too much, but a lot of times I see the request all the time from banks that are doing loans on units and condos or single family homes. They want to know that you got general liability, a fidelity bond. If you have property to insure, is the clubhouse insured? Are the condos insured by the master? If you're in a high risk flood zone, do you have flood insurance? Lender requirements come and go and they change. And we try to make sure that we're keeping them happy, but we can't always keep them happy. Sometimes, you just have to find a different lender that has different requirements. No one wants to impede the sale of a unit, but sometimes it happens based upon insurance requirements, especially when you deal with lenders that are from up north. They'll be like, oh, well, up here we do it this way. Well, welcome to Florida. We don't do it that way. So a lot of times it's a little different with insurance. I'm kind of going to leave this last part off, admitted, non-admitted. I think it's not super relevant. I'll put it up there so if someone looks at the recording and they want to see it later on. Different types of market, admitted, non-admitted. I'm not going to dig into it. It's not super relevant. Does anyone sell sinkhole coverage was one of the questions. They're not going to sell it standalone, but insurance companies, you just need to find out if they sell it or if they don't. If it's for a single family home, I don't sell that kind of insurance. You're just going to need to talk to your local agent about it. If you're in a super high prone area, it's going to be tough to get. And if it's a condo, then we just need to talk to the carrier, see if we can add it, see if it's available or not. Again, if you have catastrophic ground cover collapse, that's gonna really cover you in a lot of scenarios. Sinkhole is really more, again, the reason why there's a definition difference in insurance is because, like everything, people try to find loopholes. And so what happened was there were guys going around years ago, guys and gals going up to houses and saying, oh, you see the little stair step crack on the side of your house on the block, which like every home in Florida has. They would say, well, guess what? You probably got a sinkhole and we're going to file a massive claim against your insurance policy, buddy, and you're going to get a payout. So the insurance companies found a way around that, which was differentiating between sinkhole and catastrophic ground cover collapse. If the ground opens up and swallows half your house, chances are you got coverage. If it's a slow settling where there's a little crack in the side of the house, you probably don't have coverage, or if you do, there's a whole bunch of steps to go through to get coverage. You might have to do core sample drillings of the ground, all kinds of stuff. Last couple questions that are flying in here with 2 minutes left. What insurance covers the retention pond? So there's no insurance that I'm aware of that will cover the physical damage of a retention pond. If you're talking about people falling into the retention pond, then that's on your general liability policy. And you did say for liability, sorry. So yes, it's going to be your general liability policy. And some carriers rate for that. Like if you have a general liability policy with auto owners, they're going to rate for every pond in your community. And let me tell you this, if you have a master community and you're one of 7 sub associations inside of a master, some of the ponds are in your association, but some are not. Some are just within the master. Auto owners is going to rate for every single pond within a reasonable distance of your community. You may say, we only got 2 ponds, but they're rating us for 15 ponds. Well, that's because they think they're close enough to where if somebody gets drowns or something happens, you might get named in the lawsuit. So but the liability would be on your general liability policy. Okay, so I've talked for about an hour straight. Lizzie, I don't know where we want to go from here. We're pretty much at our time. Alligator attacks in the pond. Sorry, another question popped up before I throw it back to you, Lizzie. It's not a bad question though. You should have signage. If you're around, if you have a pond, you should have signage that talks about no fishing, no swimming, no whatever. And if there are wildlife, warning, potential wildlife, alligators, whatever it might be. So be prepared to have some signage up if you have a pond. I would highly, highly recommend that. All right.
Thank
Where
you,
do I go?
Doug. That was wonderful. We appreciate your time. As I said in the beginning, everyone, if you would like a recording of the presentation, please email events@greenacre.com, and I'd be happy to pass along the recording along with the information that Doug reviewed tonight. And thank you all again. Doug, it was a pleasure to have you on.
Thanks, guys.
Have a good evening, everyone.